What's up, Stock Geeks? Travis here. U.S. stocks had a great week last week, but maybe the story of the week was Alibaba and Chinese stocks joining the party and ripping higher. I've got some exposure in the public portfolio, so I've got to think through some of the sell decisions, profit taking, whether or not the trade has more legs to it. We'll talk about that. I'll also talk about a newer position I added to the portfolio recently. We'll talk through some of the earnings fireworks we're seeing out there. Lots to cover. Let's dive right in. Okay, so first things first, I'll give you an update here on the 100K portfolio. If you've been following along, you know I funded this in late October with a fresh 100K of capital. I've been working to get this thing more fully invested. Still, even as of February 16th, it's 79% in cash and only 21% invested. But despite that, a pretty good return so far, up almost 10% and beating the S&P, even with that low exposure. But I'll be working to get it more invested here in the next couple months. Current portfolio holdings looks pretty similar to what I showed you last time, although that mystery position from last time is Uber. We're going to talk about this here in a minute. So there is another mystery position that I recently bought as of late last week. Not yet ready to talk about that one. But let's talk Uber. So I was able to get an entry on Uber the day they reported Q4 earnings, which was February 5th. Uber reported pre-market a very good earnings report. Revenue was up 20% year over year. EBITDA was up 44%. And yet the stock sold off 7 or 8%. So I was able to get an entry at $65 a share, which is effectively 20 times their 2025 earnings estimate. And that's a below market multiple for a business that I consider to be above average. And the business, like I said, grew 20% last year on the top line, even faster on the bottom line. This year expected to grow revenue 15% or higher. And EBITDA and free cash flow are expected to grow again this year at north of 30%. So very good cost control and efficiency, allowing them to grow the bottom line at a very fast rate. And they're the dominant player in the rideshare industry, which is a duopoly. So very good business characteristics. Of course, they also have the food delivery business where they're a big player as well. Now, there are some concerns about the threat from autonomous vehicle networks from companies like Waymo and Tesla. And those are a real risk. I don't want to downplay it too much, but I do think Uber can fend that risk off. And I do think some of those concerns are perhaps a little bit overblown. Uber actually has a key partnership with Waymo, which is the more aggressive of the AV companies right now in terms of rolling out new markets. But Uber has a partnership to roll out some of those new markets in conjunction with Waymo in cities like Austin and Atlanta. So Uber is a key partner, and Uber sees a future where Waymo and other companies actually offer some of their AV rides on the Uber platform so that you can choose between human-driven rides and AV rides. And they think also AV rides will be a premium price product, at least for the next couple of years. So I do think Uber is still in a strong position. It is a risk I will continue to monitor. But interestingly enough, Bill Ackman came out with his Uber investment thesis just a couple of days after I bought the stock. Apparently, he saw a lot of the same things that I saw. So he owns more than 30 million shares of Uber, and he sees it as a very high quality business in a duopoly industry with an attractive valuation and very, very good growth. And I agree, and it's great to have another high-profile investor on board. But you can see here the revenue growth of Uber has been very impressive, but what's even more impressive is that they flipped to profitability and then started growing operating profit and cash flows at a very high rate just in the last, call it 2 years or so. There were some bears that thought that Uber would be unprofitable forever and that it wasn't a good business, and they have proven those bears wrong. So it's really great to see the cost efficiencies and seeing expenses grow much slower than revenues, which is allowing the bottom line profits to grow faster than revenues. We call that operating leverage, and it's a great quality to have in any investment that you own. So that's Uber in a nutshell. And again, I'm up about 20% on it so far, but I'm going to continue holding it. It's trading now at about 24 times this year's earnings and growing at a very nice rate. And so I think it could be a good position to own for the years ahead, and I'll continue to reevaluate those risks around AVs. That brings us to Alibaba, which has been another great performer in the portfolio so far, and I actually took some profit on some of my positions. So if you've been following the portfolio, you know I had a call option position in Alibaba. I bought 3 calls that expire in January of 2026 with a $125 strike price, and those calls have done phenomenally well. In fact, they're up over 300% from when I bought them, and that's because Alibaba stock has gone nearly parabolic. It's up almost 50% since the start of the year, and those calls are up even more. I had a tough decision to make here, though, which was, do I take some profits? And I struggled with it, but then I ultimately decided I was going to sell 1/3 or one contract out of the position, which more than paid for all of the cost basis. It returned more than the entire cost basis of the position, which allows me to hold the rest of the position for basically a free ride. So let's talk about why I chose to ultimately sell part of the position. I kind of bucket it into 2 different buckets, risk management and regret management. On the risk management side, I did kind of look at the stock and say it probably is going to have a pullback or consolidation period after such a fast move. So it could be a good time to take some profit, number one. Number two, the position size was getting a lot larger. So it had gotten to about a 5% position in the portfolio, which by itself is not a huge position, but for an options position, I consider that to be pretty large. And then also, because these were far out of the money options that had become a lot closer to the money, they're going to have less upside percentage for a given stock move going forward than they did when I bought them back when the stock was under 90. We call that option delta. So without getting into the weeds, basically, as the stock rises and the option rises, the option will act more and more like the underlying stock. And so the upside or the risk reward isn't quite as good as it was when I bought it when the stock was much lower. So there's also regret management or regret minimization. So I was able to basically take out more than the entire cost basis of the position by only selling part of the position. And that, again, allows me to kind of have a free ride on the rest of the position. So I can hold that without having to worry about this trade ever falling into a loss position. I'm basically guaranteed to be in a gain position on this trade. And that actually helps me to hold the rest of the position potentially for a longer time period and be more comfortable sitting on it. So that was another factor here. I always like to say that perfect is the enemy of the good, because no trader is going to pick the perfect bottom and the perfect top of a stock, at least not every single time. You might do it once in your life, but you're not going to do it every time. And so you don't want to hold yourself to a perfection standard. My goal is to try to capture the meat of the move on a stock, to hit my price targets and scale out along the way, rather than trying to be greedy and, giving back profit on a position that I was up a lot on. And potentially even some people, ride a stock up and then ride it all the way back down to losses. And I don't want to do that. And so what I try to do, again, is try to capture the meat of the move. This is just a chart example, simple chart where, perhaps you buy something down here, which is a great entry on a pullback, when the stock is early on in its move, and you sell some on the first dip, and you sell some near this, euphoric peak, and you sell some when your technicals are flashing red and the stock is selling off, right? And if you average those out, your weighted average sell price is still going to get you a very good return overall. It may not get you this, if you had sold everything at the peak, it may not get you that same type of return. But again, holding yourself to that standard and believing you're going to get a sell at the exact top on a stock is pretty unrealistic. And so again, I just try to shoot for what I think is a very good return based on my targets and based on my risk management, rather than trying to hold myself to a perfection standard. And I encourage you to do the same. Now, why did I enter into the Alibaba trade in the first place? Well, before we talk about why one might own Chinese stocks, let's talk about all the reasons why you don't want to own Chinese stocks. For one, they've been terrible performers generally over the past few years, but there's a lot of risks involved. On the macro side, you've got a Chinese economy that's been weak with a property sector bust. You have the CCP involvement in a lot of Chinese companies, and so you've had like the CCP kick Jack Ma out of Alibaba. You had them pull Didi Chuxing, the Uber of China, off the U.S. market. You've had them, take sanctions against the for-profit education companies in China. So there's issues there. There's issues with the relationship between the U.S. and China now with the ongoing trade war and potential tariffs. On the micro risk side, Chinese companies that are traded on U.S. markets are typically VIEs, variable interest entities. So when you own that company shares, you own shares in a Cayman Islands company that has a contract with the domestic mainland Chinese company, because there are foreign ownership rules against foreigners owning the equity directly in Chinese companies. We have these VIE structures that live in the Caymans, and that's the equity that you actually own as a US-based investor in most cases. And so there's this thinking that in a worst case scenario with a US-China war or something like that, overnight, these VIEs would just be shut off and US investors would be left with zero. Or maybe what happens is these companies could get delisted, like we saw with Russian companies after the Russia invasion of Ukraine, which could leave U.S. investors with lots of losses if they're holding Chinese stocks. We've also seen some various accounting frauds with smaller cap Chinese companies over time. There's the fact that we have a language barrier. How do we really research companies on an on-the-ground level when we're sitting here in North America? Not that many people are going to be traveling to China and really understanding what's happening at the lowest levels there. And of course, there's also fierce competition. We've seen like the solar sector and the EV sector really get eaten up by competition from all these different Chinese firms. And so there's a lot of reasons why you wouldn't want to own Chinese stocks, but why would you? Well, I think, that there's an interesting turning point here with sentiment, and it's not like I want to make China my biggest portion of the portfolio, but the Chinese economy is improving, and the Chinese are stimulating their economy and doing direct consumer stimulus this year. Fiscal stimulus will help the Chinese economy. I mean, if you remember back in 2008, 2009, the whole world thought the U.S. was in trouble and it would never work itself out of the GFC, and it was all going to be bunkers and eating canned beans. And then, the stimulus started to work and the market started to turn up and things got better. And so I think that's what can happen in Chinese stocks. I do think the CCP is taking a little bit more of a positive role towards a lot of these Chinese companies because they want their own stock market to start performing better. And the Chinese have a lot going for them. We saw with DeepSeek and some of their advancements in drone technology and EVs and other sectors that the Chinese have a lot of technical capabilities, and also they're able to build manufacturing facilities and power plants and things probably faster than almost any country. There's a lot to really learn from them and a lot to admire on some of the infrastructure side in China. On a micro side, we are seeing Chinese companies, even though there's these VIE structures, they are now starting to pay dividends and do share buybacks. And I think that's a big part of the story here, to have capital returns for U.S. shareholders on these Chinese stocks. And these Chinese stocks are still trading at a fraction of the valuations of their U.S. counterparts. So all of these things, I think, play into the opportunity for Chinese stocks. And granted, I don't think, maybe they're ever going to trade at quite the same valuation as, say, a Tesla or a Amazon or Microsoft, but perhaps they deserve to not trade at 8 times earnings when they're growing earnings at a rapid rate and buying back stock. And so that's one of the things that I see with the China stock opportunity. And there's different ones with different characteristics here. These are just some of the larger ones that are publicly traded. And you can see, these valuations. I think the median PE ratio right now for this group of Chinese large caps is something like 12 or 13 times earnings. And a lot of these are buying back stock, and a lot of these are growing and expected to grow revenues in the next couple of years. So I think there is potentially some significant upside if this trade really starts to take off. Now, we have seen really, really fast growth in these share prices just in the last couple of weeks. And so, again, we could be in for a period of pullback or consolidation on some of these Chinese stocks. But, I do think some of them potentially have a lot more upside on a longer term basis still. And by the way, if you want to read a really good piece on the prejudices of Western investors against China that I found very illuminating, Gavcow is a great research outfit that put out a good post on what they see as far as the media bias and the bias against China here in the West that has clouded investor judgment. I thought this was a really great read. So I'll put this in the description. I think it's worth your time, and it helps to inform, why there might be a shift in sentiment at some point and how that could benefit the trade overall. Okay, so moving on from Chinese stocks, let's talk about some of the current market action here on the U.S. side. Y'all, we're 6 weeks in, and we've seen some crazy moves in stocks already this year. Stocks like Cloudflare and Hims & Hers and Palantir and Oklo and AppLove and you name it. I count 69 companies above a $300 million market cap that have already put up 50% or better year to date, and we're only 6 weeks in, which is wild. So one of the stocks that we saw last week pull a big move was Hims & Hers, ticker symbol HIMS. And apparently everybody knows this stock now. It's the hot, trendy stock on YouTube and X. But a couple of years back, I actually bought this stock when it was a post-SPAC bust at $6 a share, when not that many people knew about it. I alerted our Wealth Incubator community members about it. Now, I have sold most of mine along the way. I didn't expect to see the stock at above $60 a share in 2.5 years, frankly. But you can't deny the company has had a really impressive subscriber and revenue growth. This company started out, I think my friends called it a boner pill company because they were a significant portion of their early customers were men who were looking for an easier online way to get access to ED pills. And that certainly is one area they were strong in, but they've expanded to dermatology and weight loss drugs and hair loss drugs and all these other things. And so they've done a really good job expanding the business. They also had one of the more effective Super Bowl commercials last week. And so that has helped drive the stock in addition to a short squeeze, high short interest, and those shorts are getting crushed. So interesting to see that. Now, Hims reports earnings, not this week, but next. And so there's some risk obviously around earnings. I probably wouldn't be buying the stock myself at this price anyway, but fundamentally the company is doing a lot of really interesting and positive things. So it will be interesting to tune into their earnings. Now, last week, another company that burned the shorts was Upstart, the online lender, and I was surprised by this. I actually expected Upstart to have a weaker quarter because during the fourth quarter, we had the 10-year yield rising, and that meant loans were getting more expensive again. But apparently, it didn't affect loan demand at Upstart. because Upstart put up loan growth of 68% year over year in the fourth quarter, which was, 30% plus quarter over quarter. So pretty good growth there. And what I find interesting about Upstart, one of the things I find interesting is that it's part of this class of stocks that we've seen rising lately, which were 2022 bust stocks that went bust in the 2021-2022 bear market for tech stocks. And they got washed out and were down, 80, 90%. And then they've made a comeback with a little bit of fundamental momentum. Companies like Carvana and Root and Upstart and others have started to have this renaissance. And so I've been looking for other companies that might meet this sort of criteria where they've been washed out, but maybe are starting to make a comeback. And so I think that's an interesting thematic theme that we've seen here in markets recently. One thing that makes me a little bit nervous about the current market is that stocks in general have kind of been ignoring this inflation uptick. And we've had 4 straight months of a rising CPI, and we got a hotter than expected CPI last week, up 3% year over year. We also got a hotter than expected PPI. And typically we would think that if you get enough of these hotter inflation prints, the market's going to start worrying about inflation again, send yields up, and then we're going to have another big stock correction. But the 10-year yield has actually been in decline over the last couple of weeks. And last week it declined a little bit because a lot of analysts were looking at some of the subcomponents of the CPI and PPI and saying that, it's not as bad as the overall headline number. And the market may be looking forward to predicted lower upticks in the CPI in the months ahead as some of the shelter costs start to weigh the CPI down, because shelter costs are continuing to come down. So it's a long way of saying, stocks have been ignoring inflation. Some for good reason, perhaps also just ignoring risks because we're in a big bull market. So it does make me a little nervous, just something to keep an eye on. But those hotter inflation prints last week did not stop the honey badger market. Stocks went higher, and that is definitely worth noting. Now, that kind of relates to a question I got on last week's video where Quilzy asks, are we not in an environment where everyone thinks investing is like no lose? Like all my colleagues who some even live paycheck to paycheck are talking about investing, and all these people are getting involved with investing. So I thought this was an interesting question. I wanted to go look for evidence of this. Certainly we've seen a lot of stocks move up a lot lately, but when you look at some of the sentiment gauges, the AAII institutional investor sentiment gauge is actually at a 1-year high of bearishness, not bullishness. So institutional investors at least seem like they are looking at the market action or looking at the inflation stuff and getting bearish. And so even though we have stock prices up, institutional investors certainly aren't displaying extreme greed or even greed at all. I thought that was interesting. And then when you look at the amount of stocks that are above their key, 20, 50, 100, 200-day moving averages, there's actually a good amount of stocks out there in some of the major indices like the S&P 500 that are below key moving averages. And so the whole market is not necessarily participating. Now, we do have more stocks starting to rise above their shorter term moving averages. So it does appear like more of the market is moving into a more exuberant phase, but we're not at the point where like all stocks are participating. We have seen, again, some pretty big reactions on stocks that are producing positive earnings. So I think what we're seeing big moves in stocks that are putting up good numbers, but the rest of the market isn't really joining in this greed parade. But certainly these moves on earnings have been pretty wild. I mentioned AppLovin was up over 30% on their earnings, a very good blowout earnings report. Airbnb put up another solid result, and that stock had been kind of chopping around, but it's now up 20% over the last couple of sessions. We've got Robinhood, which I'll talk about here in a minute, having a very, very good couple of months. There are some dogs here. We had stocks like Reddit and Lyft and Trade Desk sell off after earnings, but overall, you can see that these are big moves both up and down off of some of these earnings reports. I want to talk a little bit about Robinhood and Coinbase, which both reported earnings last week. And as you know, Coinbase is part of the 100K portfolio. I have a small position in Coinbase. And I said in the last video, I expect Coinbase to smash Q4 earnings estimates, and analysts are way underestimating what Coinbase is going to deliver for Q4 and for 2025. I was certainly right about Q4. Coinbase delivered EPS of $4.68 versus the average analyst estimate, which was below $2.50. So they smashed earnings estimates. They also smashed revenue estimates. They beat the analyst estimate for revenue by more than $400 million for a single quarter. I mean, that's massive. And we also saw Robinhood do something similar. They put up EPS of over $1 when analysts were estimating like 50 cents a share. So they doubled the analyst estimate. I mean, these were blowout Q4 reports for both Robinhood and Coinbase, yet the stock reactions couldn't have been more different. Robinhood gapped up. The stock was up 17% for the week. Coinbase was down on Friday after the earnings report, 7 or 8%, and ended the week roughly flat. So Coinbase investors like myself did not get much love, even though they just blew out the numbers and were super positive on the earnings call. And what this goes to show, once again, another lesson is that in the short run, stocks can really do strange things. One, because earnings are all a game of expectations. If all the investors know that the company is going to beat, well, if they don't beat by enough, the stock can be down, even with good numbers. So that's one factor. But also, sometimes stocks just move for random reasons in the short run. Even though Robinhood and Coinbase share a lot of the same drivers. I mean, Robinhood has like a third of the business in crypto. The Coinbase numbers, I guess, weren't enough to move the stock in the short run. But that's also why I focus on the trajectory of fundamentals in the longer term, because the stock will follow the fundamentals long term. And I expect, if Coinbase can deliver good numbers this year, that the stock will rise. Maybe I'll get an opportunity to buy the stock cheaper because of this pessimism in Coinbase. I would love that, actually. I kind of sometimes root for stocks to have corrections so I can buy them cheaper and make my positions bigger, especially when things are going right fundamentally. But yeah, Reddit was another stock that showed this, where the stock put up great, or the company put up great numbers, and yet it gapped down 15% after the report, even though they beat analyst estimates and revenue was above expectations. I don't feel too bad for Reddit shareholders, at least the longer term ones, because even though it was down a lot last week, despite a good earnings report, you look at what the stock has done over the past year, 2 years, or since IPO, it's been a monster. So perhaps the expectations just were too hot going into the report, and you'd had the stock, which ran up a lot going into the report. So you needed just something spectacular for the stock to gap up, I guess. But it just goes to show you that sometimes going into an earnings event, things can be priced in, or sometimes earnings reactions are just one of those things that causes a random stock price reaction in the short run. There are a lot of reasons the stock can move in the short run, not always fundamental. So it's important to remember that. That's also why I don't take a ton of Wall Street bet style options gambles on companies going into earnings. Even when I know the company is going to beat estimates like Coinbase, the stock won't always move like you expect it to. So looking forward, I want to point out something I think is an interesting dynamic here with the Mag 7, specifically around earnings. We're seeing all these smaller companies beating earnings. The Magnificent 7 also has a 6 or 7 quarter history of beating earnings. But this most recent quarter, something interesting happened. The Mag 7 did not report a surprise versus the analyst expectation for revenues. Now, what does that mean? Well, it means that the revenues basically came in line with analyst expectations, and they are growing. The median revenue growth rate of the Mag 7, besides NVIDIA, who hasn't reported yet, was about 12% revenue growth, which is good. But it's no longer surprising analysts. And so that could be a headwind for some of the Mag 7. The other thing I expect to be a headwind for the Mag 7 later on in 2025 and going on in 2026 is all this heavy CapEx spend is eventually going to work its way onto the income statement because it becomes depreciation expense. And so that's going to become a headwind for earnings growth as well. So if Mag 7 stops delivering revenue upside surprises and they start having earnings headwinds as well with all this heavy CapEx spend on AI, we could see the Mag 7 outperformance really start to wane, and we could see perhaps hopefully other parts of the market continue to outperform Mag 7. What I hope doesn't happen is the Mag 7 takes a dump and then takes the entire market with it. That's also a risk. But I do want to highlight that the Mag 7 outperformance may be starting to near its end after a couple years of the Mag 7 just smashing everything else. The other thing worth keeping in mind, of course, NVIDIA earnings here, not this week, but next week, is being priced as a potentially volatile event. This is something to have on your radar if you're doing more shorter term trades. Certainly a risk to the market in the short run is what happens on the NVIDIA earnings report. We know what happened when the DeepSeek news came out. What is NVIDIA going to have to say? What are the numbers going to look like? The whole market's going to be watching NVIDIA earnings. And in fact, Kevin from the Macro Tourist, a Substack that I pay for, posted this great chart showing that the highest volatility event right now that the market's pricing in the next couple of weeks is NVIDIA earnings. It's not the CPI, it's not the employment report, it's NVIDIA earnings. So we're going to be watching out for that. And that's a key thing to have in your calendar if you are making decisions on a day-to-day basis here in the market. Speaking of the semiconductor sector, look, I'm always on the hunt for stock ideas, and something stood out this week in AMD. It's the first time an insider executive at AMD has bought stock since 2012. Back in 2012, Lisa Su bought AMD stock at $2 a share before the turnaround really started to work. Great purchase by her, by the way. And we've seen a lot of selling of AMD stock in the last decade by executives and insiders, but this is the first time we've had a buy since 2012. And so the chief commercial officer bought $500,000 of AMD stock on February 7th. And I think this is notable, especially considering the fact that AMD has really been in a downtrend for the better part of the last year, despite growing on the top line and bottom line. So AMD is certainly going to be some beneficiary of the AI spend. And I think it's an interesting signal to see one of the insiders stepping up for the first time in over a decade. So that is something I wanted to call out. I probably need to do some more work on AMD. One thing I want to call out on the risk side that I think no one's really talking about right now is Japanese government bond yields. These have been on the rise and have been accelerating in recent weeks. And so the Japanese government bond yields, because they're rising, this could create actually some upward pressure on the yen. The yen has been a weak currency. There's all these carry trades that are borrowing in yen to buy other assets. But if the yen strengthens, this could cause one of those reversals in the carry trade like we saw in August of 2024. And therefore, we could see risk assets sell off if these yields on Japanese bonds keep rising at a rapid rate. Now, I do expect the Japanese government to step in at some point and do yield curve control and buy bonds and suppress these yields. But before that happens, we could see this thing take off and we could see a sell-off in global markets. So that's just something to keep in the back of your mind. I would love to see a correction, by the way, but something that I think no one's really talking about that I wanted to point out. We're also this week getting the Hedge Fund 13F filings, which are portfolio updates from hedge funds. Now, a lot of people report on this and a lot of people get it wrong. A couple caveats you need to know about 13F filings. So any hedge fund or institutional investment firm with over $100 million in assets has to report to the SEC its US-based holdings, at least on the long side. Now, these holdings are reported 45 days late. So they're reporting end of quarter from the end of the fourth quarter, but we're 6 weeks into the year, right? We're 45 days. It's February 16th, 17th. And that means that these portfolios that we're seeing are from December 31st. So when you see a hedge fund, especially one that's really, really active, that's showing some of its long positions as of December 31st, well, those positions could have been sold. They could have, done something different in the meantime with those positions. So they could be stale. And that's something you have to keep in mind, especially for funds that are very actively trading. The other thing to keep in mind is that it doesn't show short positions or hedges, so you don't always get the full picture of what's happening in these portfolios. It doesn't show international positions, and so that's another issue with these 13F filings. And so we can get some idea generation, especially from the funds that have very low turnover, that are not trading stocks rapidly. But if you're looking at, say, a Millennium or a Citadel, those positions are going to change on a day-to-day basis. So these 45-day stale 13F filings are not going to be very useful. But I do look at some funds' positions because they don't change very often and they can be really good for idea generation. So in our Wealth Incubator community, I share a list of hedge funds that I follow for these 13Fs. Places where you can track these, Whale Wisdom, Dataroma is another site that a lot of investors use. I know Koifin is going to be adding 13F tracking soon. So there's a lot of good free websites you can go to look up if you know the name of the hedge fund or you know the name of the stock and you want to see who the holders are. You can go in and click around and see what's in those portfolios. Again, as of December 31st, not as of real time. So it's important to keep that in mind. And that brings us to our question of the week. A couple of you in the comments of the last video asked about investing book recommendations. Now, I did a video a couple years ago on my favorite investing books, and I'll link that up, but it probably does need a refresh. So I'll try to do that this year at some point. But one book I always recommend for newer investors is One Up on Wall Street by Peter Lynch. And I really like this book because it covers a lot of ground, but it's a really easy and accessible read. So it was written by one of the OG mutual fund managers, Peter Lynch, and I just find it to be a really good broad coverage of investing. And it talks about idea generation in your own life and just a lot of really great topics there. I also like 100 Baggers, which I mentioned in last week's video, because it walks through just a lot of really interesting concepts around finding stocks and how do you find stocks that are going to end up outperforming everything else in the market and finding these multi-bagger stocks. It walks through studies of past winners, and so that's a really good one. I don't recommend something like The Intelligent Investor to newer investors. That is frankly just a very dense and dry book, and so I know that it gets recommended a lot. I just don't think you're going to get through it and get a lot of value from it if you're a newer investor. You're just probably going to be bored to tears. So there's no one book in investing that covers everything because investing is just such a broad topic and there's so many different niche areas within investing you can dive into, whether it's quant or options or momentum or trading. So what I do try to tell people is that if you're serious about going from more of a novice to a more of an advanced investor and you want to understand fundamental investing, that's why I created my 8-week boot camp. We're going to be running that live here at some point in the next couple months. So I'll put the waitlist in the description, but this is something I put together because I never had a resource myself that I felt like really was super comprehensive. And so I built that. It's 30 plus hours of content. And I think, people who take it get a ton of value out of it. It's basically like taking a university course. So in any case, I'll link that up, and I love these comments and questions, so please keep them coming. If you have any thoughts on Chinese stocks or some of the stocks I mentioned today, let me know. If you have questions, please hit me up in the comments, and I will see you in the next video. Cheers.